I noticed Starlink was cutting prices. Then I checked the date, April 1st, 2026. That was the day SpaceX confidentially filed for its IPO, a company asking the market to value it at 1.75 trillion. And on that same day, it cut the price of its products by 30%. Those two things should not happen at the same time. 13 days later, Amazon spent $11.6 billion on a satellite company. The 6-year Starlink monopoly is over. So where does 1.75 trillion come from? Not the rockets. Here's how it is built. SpaceX launched its commercial satellite internet service in 2019. It is called Starlink. By February 2026, Starlink had 10 million subscribers. Revenue in 2025 was 11.4 billion. It is growing at roughly 50% a year. But the number that carries the valuation is not revenue. It is the margin. Starlink runs at a 63% EBITDA margin. EBITDA margin means for every $100 Starlink collects, $63 stays at operating profit. Think of it like a restaurant that brings in $100 in sales and keeps $63 after paying for ingredients, staff, and rent. A typical broadband company keeps $30 to $35. A typical streaming keeps $20 to $25. Starlink is keeping nearly double what the best telecoms in the world keep. A 63% inside a business that involves launching hardware into orbit is not normal. Before you assign a number to it, it is worth asking where it comes from. I went looking for that answer. When I found it, I stopped and read it again. Starlink does not buy rocket launchers on the open market. It launches its satellites on its own Falcon 9 rockets at an internal rate. The estimated internal cost is roughly $28 million per launch. If you are an outside customer who wants that same rocket, SpaceX charges you $74 million. There is a $46 million gap per launch. Satellite expert Tim Farah told the information that Starlink would likely be loss-making if it paid full market rates. The margin exists because Starlink never has to pay what anyone else would have to pay to do the same thing. I want to be clear, there is not evidence of wrongdoing. It is vertical integration. Both things can be true at the same time. Starlink is a real business, and the margin that makes it worth $500 billion is one no competitor can replicate. Some of you are thinking that is precisely the moat. Owning your own launch company is a structural advantage. That is a reasonable read. Here's the question it does not answer. What happens to a margin built on cost advantage when pricing pressure forces rate down anyway? That is what the price cut is testing. 6 weeks before the IPO filing, on February 23, 2026, Elon Musk posted on X. He wrote, "This has nothing to do with Kuiper. We are just trying to make Starlink more affordable to a broader audience. The lower the cost, the more Starlink can be used by people who don't have much money, especially in the developing world." He was responding directly to reports connecting the price cuts to Amazon's satellite service. I'm not going to tell you what to make of that post. I'm going to show you what happened in the 50 days after it. March 31, 2026, Delta Airlines announced it has chosen Amazon's satellite service for in-flight Wi-Fi across 500 planes starting 2028. Delta is the highest grossing airline in the United States. It evaluated both options and chose Amazon. That announcement came one day before SpaceX filed its IPO. April 1st, 2026, SpaceX files for its IPO at $1.75 trillion. Starlink cuts prices by 30%. Same morning. April 8, 2026, Amazon's satellite service, now called Amazon Leo, launches its enterprise beta. Confirmed customers: AT&T, Verizon, Vodafone, JetBlue, NASA. April 14, 2026, Amazon announces it is buying a company called Globalstar for $11.6 billion. Elon said the price cuts had nothing to do with Kuiper on February 23rd. Amazon's CEO, Andy Jassy, answered with $11.6 billion 50 days later. Here's what the price cut actually is. Starlink has 10 million subscribers. Amazon Leo has not launched commercially yet. Right now, in April 2026, Starlink is in a position to lock those subscribers in before they can compare what Amazon is about to offer. That is what cutting prices by 30% does. It is not what you do when you are winning. It is what you do when someone is about to arrive at your door and you need people to stop shopping around. The IPO filing on the same morning is the other half of the same move. Lock in the 1.75 trillion valuation before competitive evidence makes that number harder to defend. If this breakdown is useful, hit like and subscribe. I go this deep every week. Amazon has been building its satellite service since 2019. Until November 2025, it was called Project Kuiper. Then Amazon rebranded it Amazon Leo. That rebranding matters. Kuiper was a project. Leo is a product. Andy Jassy published his 2025 annual shareholder letter on April 9, 2026. He did not name Starlink once. He wrote, "The performance will be stronger, about 6 to 8 times better on uplink and 2 times better on downlink than what customers have access to now. And this performance will come at a lower cost than alternatives. There is only one alternative he could mean." Jesse's letter goes much deeper into where Amazon Leo is headed. If you want me to cover that letter in full, comment letter below. 6 to 8 times better on uplink speed is not a marginal improvement. Uplink is what matters most for businesses sending data back to servers. Video calls, remote monitoring, industrial sensors. The enterprise segment Starlink has been trying to lock in. Jesse described a product that is categorically better at the thing enterprise customers care about most. He stated the metrics and moved on. No press release energy, no competitive posturing, just numbers. Now, there is a real constraint on Amazon's timeline. Amazon's FCC license requires 1,618 satellites in orbit by July 30th, 2026. As of April 2026, Amazon has 241 in orbit. That gap is 1,377 satellites in roughly 3 months. Not achievable at current launch pace. Amazon will almost certainly need to request a waiver or extension. I want to be fair here. The deadline is real. Amazon may not hit it, but the pattern in FCC proceedings around major infrastructure tells you something. Regulators do not typically revoke the license of the second largest company in the world when it is building out a system the FCC specifically wants to exist. The deadline creates leverage. It does not necessarily create a cliff. Now, here is the part that changed the shape of this story. On April 14, 2026, 13 days after Starlink's price cut, Amazon announced it was buying Globalstar for $11.6 billion. Think of it like the water pipes under a city. The buildings above are what people live in, but without the pipes, nothing works. You can build 1,000 apartments and still have no running water. Globalstar owns the pipes. More specifically, it holds S-band spectrum licenses covering most of the planet. It runs the ground stations that make satellite signals reliable at scale. It powers the emergency SOS feature on every iPhone sold today. What Amazon bought is not more capacity. It is the ability to send signals directly to a smartphone. No dish, no terminal on the roof, no equipment setup, a phone in a pocket. Starlink cannot do this yet. Amazon spent $11.6 billion on the one capability that reaches the 8 billion people who own smartphones but do not own a satellite dish. 13 days is not enough time to negotiate and close an $11.6 billion acquisition. This deal was already in motion. Jesse let Starlink cut prices first, then he moved. One more thing on the launch cost picture. On April 19, 2026, Jeff Bezos posted a video of Blue Origin's New Glenn rocket landing its first stage successfully for the first time on a reused flight. A reusable New Glenn changes the economics of getting satellites into orbit. Long term, There is a direct challenge to the Falcon 9 cost advantage we covered in section 1. I'm making a dedicated video on exactly what that is. Watch for it. Starlink is a subscription business. For any subscription business, 3 numbers determine what it is actually worth. How many subscribers you have, how much each one pays, and how many leave every month. Starlink has published subscriber counts since 2022, 10 million as of February 2026. It has never published how many leave. Churn rate is the percentage of subscribers who cancel each month. For a broadband business to be healthy, annual churn needs to stay below roughly 5%. If annual churn is 15 or 20%, the subscriber count can still be rising while the business is losing ground. It has to acquire new customers faster than it loses the existing ones just to hold the number flat. Starlink has not published this number once in 6 years. When I found that, I checked whether any comparable satellite or telecom business omits this disclosure. None of the ones I found do. The S1 filing will carry Starlink's churn rate for the first time in the company's history. Every analyst covering this story has identified it as the single most important unknown in the entire document. In my previous SpaceX videos, I covered in detail how much each Starlink subscribers actually pays and what that means for the valuation. Link in the description. That number has its own story. This section is about the one that has never appeared anywhere. Some of you are thinking the filing will fix the information gap. All the numbers come out and you evaluate them. That is true, but the window to buy at the IPO price closes in roughly the same window as the document drops. Most retail investors will be making that call before they have a chance to sit with what that churn number actually means. For anyone planning to buy SpaceX shares at the IPO or through a pre-IPO vehicle, churn is the first number to find, not the revenue headline, not the subscriber count, the number that tells you how many of those 10 million are actually staying. This has happened before. In 1994, a company called DirecTV launched a satellite TV service. Cable television had held a local monopoly for roughly 20 years. One company, one price, no meaningful option to compete against. DirecTV was the first real competitor. In May 1995, cable TV lost subscribers for the first time in its history. The following year, Dish Network entered with lower prices. Cable companies started cutting rates to hold customers. By 2001, satellite TV subscribers had more than doubled. Cable stopped raising its prices for 3 years. The premium the market had placed on having no alternative disappeared. That is the pattern. Monopoly pricing holds until the second player proves it can serve customers at scale. Once that proof exists, pricing power does not erode slowly. It resets. The market recalibrates around a world with 2 options instead of 1. Amazon Leo's Enterprise Beta launched April 8, 2026. AT&T, Verizon, NASA, Delta Airlines. That is the moment the second player proved it can serve customers. If the DirecTV pattern holds, Starlink's margins compress over the next 12 to 18 months, from 63% toward 45 to 50%. That is not the end of the business, but it is a significant problem for a valuation that treats 63% as a permanent baseline. Cable's margin fell in 1996 and 1997. The cable industry did not collapse, but the premium that came from having no competition was gone, and it did not return. This matters beyond the trade. Starlink has been the default internet option for millions of people in rural areas, on ships, on aircraft, in countries where no cable ever ran. If genuine competition drives prices lower, those people pay less for connectivity. There is a real benefit. The question is who absorbs the margin difference, and whether a valuation of 1.75 trillion is already pricing that in. I have covered SpaceX a few times on this channel. After this research, I am not less impressed by what Starlink built in 6 years. I am more specific about what I do not know. The churn rate, which has never once been published, will tell me more about what this business actually is than anything else that comes out of this IPO process. That is the number I am waiting for before I form a view on the price. 3 things I'm watching from here. Amazon Leo's commercial pricing announcement. When Amazon publishes what consumers will pay, that number will tell you more about Starlink's margin pressure than any analyst estimate. Amazon Leo's FCC filing timeline. Watch for any waiver request before July 30th, 2026. Whether Amazon hits the satellite deployment deadline, negotiates an extension, or misses it determines how fast real competition becomes real pricing pressure on Starlink. Starlink's next pricing move. It cut prices on April 1st. If there is a second cut before Amazon Leo's commercial launch, that tells you something different from the first one. On April 1st, 2026, a company asked the market to value it at 1.75 trillion. On the same morning, it cut its prices by 30%. The 63% margin that makes that number defensible had never been tested by a competitor at scale. The churn rate that would tell you whether 10 million subscribers is the right starting point had never been published. The decisions about what this business is worth were filed and priced before the number that most determines whether the price is right has ever been seen. When Amazon Leo's first subscriber count is published and Starlink's churn rate is published for the first time, and both numbers sit next to a $1.75 trillion valuation, will the monopoly premium still be there? If this breakdown is useful, hit like and subscribe. I go this deep every week.